Welcome to the Art of Progress. Have you ever wondered how you can invest in the stock market without having to pick individual stocks? Index investing allows you to invest in a broad market index, providing diversification and reducing risk. Meanwhile, ETFs are a popular investment vehicle that tracks these indices, making it easy to buy and sell shares just like stocks. In this video, we'll explore the fundamentals of index investing, how ETFs work, and why they might be the right choice for your investment strategy. Let's get started. Understanding index investing. Index investing is a type of passive investing that involves a long-term strategy of buying and holding investments. Unlike active investing, which focuses on frequently buying and selling stocks while closely monitoring performance, index investing is simpler and more straightforward. One of the biggest advantages of index investing is its low cost. Since index funds track a specific market index, they have a lower management fees compared to actively managed funds. This makes them an affordable choice for many investors. Additionally, index investing requires less financial knowledge, making it easier for those who are not experts in the field. Index funds also offer convenience by including hundreds of stocks in one fund, which would be difficult to replicate individually. This variety helps reduce specific risks associated with individual companies. However, index investing has its downsides. For instance, there is no protection against losses, so investments can decline without any safety net. Investors also have no control over which stocks are included in the index fund, and they can only expect to match market returns, not exceed them. How to start index investing? To begin index investing, the first step is to choose the right index that fits your interests. A popular choice is the S&P 500. Which includes 500 large U.S. companies. Other well-known indexes are the Dow Jones Industrial Average, made up of 30 major U.S. companies, and the NASDAQ Composite, which focuses more on technology firms. Many people consider the U.S. market to be a key financial center. If you have some investment experience, you might want to try to beat the market by focusing on specific regions or sectors. For instance, if you think Asia will do well in the future, you can invest in indexes like the Shanghai SE Composite, Hang Seng Index, or Nikkei 225. The stock market is divided into 11 sectors, like IT and healthcare, with various indexes for each. You can also consider investing based on certain factors, such as value or growth, which can perform well at different times. However, targeting a specific area increases risk. If that area does poorly, your investments will too. But with higher risk often comes the chance for higher returns. The second step is to find a fund that tracks your chosen index, comparing factors like fees and performance. Finally, to buy shares in your chosen fund, you'll need to open an account with a broker. So it's smart to compare options before making a decision. What are ETFs and how do they work? An ETF, or exchange-traded fund, is a type of investment that aims to follow the price of a specific index or a group of assets, like stocks or bonds. ETFs are popular for index investing because they are low cost and passively managed, making them ideal for tracking market indexes efficiently. Here's how it works. A financial company buys a variety of assets and then sells shares of the ETF that reflect the value of those assets. The shares can be traded on the market, similar to regular stocks. However, when you buy shares in an ETF, you don't own a part of the actual assets. Instead, the financial firm owns them and manages the ETF to keep its price aligned with the value of the underlying assets. ETFs come in many types. Some focus on stocks from specific industries, while others invest in bonds, currencies, or even mix different asset types. For instance, a stock ETF might track companies in technology, while a bond ETF could focus on government securities. ETFs can be broad, aiming to follow large market indexes like the S&P 500, or narrow, concentrating on a small group of companies. When you hold ETF shares, you'll typically pay an annual management fee known as expense ratio, which is usually low, often around 0.10%. Some brokers may charge fees for buying and selling ETFs, but many zero commissions on certain funds. Tax-wise, gains from ETFs are treated like gains from the underlying assets. If you sell an ETF after holding it for a year or less, you'll pay short-term capital gains tax. Holding it longer means lowered long-term capital gains tax. Some ETFs, especially those dealing in collectibles or energy commodities, have unique tax rules. Always research the tax implications and check with your account custodian about what types of ETFs you can hold in retirement accounts. Diversification, a core benefit of ETFs. Diversification is a key part of small investing. Instead of putting all your money into just one type of investment, it's better to create a mix of different assets. This helps protect your wealth because when some investments lose value, others might be doing well. Exchange-traded funds make it simple to diversify your portfolio. They allow you to invest in commodities, precious metals, and currencies by just buying shares of the ETF. However, remember that investing in a commodity ETF does not mean you own the actual commodity. It's important to build your ETF portfolio with a mix of different assets to meet your investment goals. Don't just focus on buying something unique or trendy. Instead, ensure your investments are well balanced and varied for the best chance of success. How do I invest in ETFs? Investing in ETFs is straightforward. You can buy and sell ETF shares through almost any broker. Just find the ticker symbol for the ETF you want and place your order, just like you would for regular stocks. Many robo-advisors also use ETFs to build their investment portfolios. If you sign up with a robo-advisor, they will invest in ETFs for you. They use simple strategies to create an investment plan based on your goals and how much risk you're comfortable with. This makes it easy for anyone to start investing in ETFs. Advantages and disadvantages of ETFs. Exchange-traded funds have both benefits and drawbacks. One of the biggest advantages is their low costs and fees, making them affordable for many investors. They provide instant diversification, meaning you can invest in a variety of assets at once, which helps spread out risk. ETFs are also easy to trade on stock exchanges, allowing you to buy and sell them like regular stocks. They offer high transparency so you can see exactly what assets and holdings are included. Additionally, ETFs give you exposure to alternative assets that might not be available through traditional investments and can be tax efficient, helping you keep more of your money. However, there are some downsides to consider. Some ETFs may be lower liquidity, which means they can be harder to sell quickly when you want to. There is also the risk that an ETF might close, requiring you to sell your investment sooner than expected. Furthermore, some ETFs may have tracking errors, causing their prices to stray significantly from the actual prices of the underlying assets or indexes. Even though you can trade ETFs throughout the day, some traders may take a while to settle, which can be inconvenient. Index investing offers a simple and effective way to grow your wealth over time, and ETFs provide an easy entry point into this strategy. What do you think about index investing? If you found this video helpful, please like, share, and subscribe for more insight.